pleasure to be here. Volatile market conditions, liquidity crunches, business continuity challenges will all become synonymous with the financial landscape in the year 2020. In a world where all forms of risk management are being scrutinized, this panel will try and address whether the events of the last 8 or 9 months have brought into question the effectiveness and the dexterity of existing frameworks. Over the next 40 minutes or so, we're going to take a look at some of the key lessons and the takeaways from market turbulence that's not been seen for a generation or more. We're going to ask ourselves how the risk management landscape has changed amid decorrelation between asset classes, the return of broad-based market volatility, and the persistent specter of further liquidity events. To discuss these topics and more, I'm joined by my 5 esteemed panelists, seasoned professionals representing major financial market participants with decades of experience in the fields of portfolio management, trade execution, client services, risk management and modeling, and margin and collateral management. Gentlemen, it's my absolute pleasure to welcome you to this panel discussion, and I'd like to invite you to introduce yourselves. So let's start with David.
Let's see, I'm heading up Interactive Brokers for Asia. Formerly, I came out here 25 years ago to start up Timber Hill's operations, where I started up electronic trading and market making. Now I spend most of my time on the brokerage, and thanks for having me.
Thanks, David. Saeed, hello.
Hi, everybody. Thank you for inviting me to this panel. So I'm currently head of risk for Southeast Asia in Amundi, Singapore. So I'm covering all the different risks in the region for the portfolio that we manage in Singapore, Malaysia. And I'm also in charge of supervising our, let's say, sales office in Thailand. I joined Amundi, Singapore 7 years ago. And I was, let's say, risk manager for the entity, and then I was headed as a risk manager 6 years ago in order to fulfill this activity.
Thanks, Saeed. Liam, hi, it's a great pleasure to have you join us.
Yeah, hi, thanks, Stefan. Liam Huxley, I'm the founder and CEO of Cassini Systems. We're a margin and collateral analytics platform that focus on helping primarily buy side, but also participants across the street understand and manage and reduce the carry cost and the post-trade impacts of their derivatives trades.
Thanks very much for that, Liam. Tony, representing the exchanges today, how are you?
Good, thank you. Thank you very much for having me on this panel. I'm Tony C. I currently head up TMX Group in Asia. For a number of years, I actually 20 plus years, I've worked in the capital markets and transaction banking space all over the world, London, Sydney, Hong Kong, Singapore, Toronto, so on, for a number of global banks. So pleasure to be here today.
Thanks, Tony. And lastly, Patrice.
Hello, everybody. Thank you very much for having me. Patrice Ronxiker here. I'm the CEO of HSBC Asset Management in Southeast Asia. Haven't been here for very long, only about 6 months. I've been in Asia 20 years, previously in Tokyo and in Hong Kong for quite a while in similar functions with the HSBC Group.
Thanks very much, Patrice. And Patrice, I'm going to start with you. From the perspective of a significant institutional asset manager, how would you summarize the challenges that you and your clients have faced during the first half of this year? And how did you draw on the lessons from previous crises to manage the market and the operational risks during a period of almost unprecedented market volatility?
Thank you, Stefan. It's interesting that you make the point about drawing from the experience from the other crises, because really this is an important point. We've learned from every crisis we've gone through, and I believe everyone on the panel is old enough to remember a few going back to perhaps the early 90s, maybe before. So every lesson learned, every lesson put into practice, and this is what has, in many respects, served us well during this crisis and allowed us to pull through. So what does it mean, really? From the perspective of an asset management company, often this is about making sure that client flows can be managed in the most efficient way possible, which is really also another way of saying that we want the promises that were made to the shareholders into the funds, be it through prospectuses or commercial documentation. We want to make sure that those promises can be met. And very often this means for the holders of those funds having the liquidity that they expect to have when they have it, where they have it. And obviously there will be differences. There are differences between different types of funds and different types of asset classes. But this is really fundamentally, it's a structuring issue. And then it becomes a financial risk management issue on a day-to-day basis. But one point we should not underestimate is the operational angle. And this is where really the unprecedented adjective becomes really useful, because I don't think we ever had before a crisis of this magnitude with most of our staff working from home. And so, in that sense, the procedures, the systems, the support that teams have given to each other has been absolutely key. We were trembling at some point, worried about operational issues. I'm glad to say that those expectations were completely wrong. And from an operational perspective, things worked as well as you can expect given the circumstances. But this is all about being ready, being prepared, and making sure that the portfolios are doing exactly what they're supposed to do.
Fantastic. No, thank you very much for that, Patrice. And you touch on so many topics there that I think would be important for you, Saeed, in your role. Amundi is obviously a global manager, albeit with a regional mandate across asset classes. One of the unique features of this crash versus those that have come before was the breakdown in the risk parity trade. This was caused in part by breakdown in correlations between asset classes. As an institutional risk manager, how did you handle this? How did you mitigate against this decoupling?
So, in direct continuity of what Patrice said, I mean, post-COVID-19 peak in March and April, the market participants were wondering whether the market goes from the moment. How should we think about portfolios or strategic construction, particularly with new market dynamics that were observed? At that time, the predominant sentiment was uncertainty and the lack of efficiency policy, precisely to give a global answer and a response to the spread of the virus around the globe, leading to face a sequential lockdown of most of the economic activities that was totally unexpected, both in terms of severity and deepness. So from a risk perspective, keywords are preparation and anticipation. As an institutional manager, we manage portfolios. Most importantly, we manage risk. To mitigate it, investment teams need to have a disciplined investment process anchored with a strong risk management policy. First step is to dispatch the roles and responsibility between the different actors, from research, portfolio management, cash management, risk management. Then it is definitely mandatory to create an appropriate risk mapping defining arrears of the launch of the strategy, where fund managers and risk managers agrees on the different limits, exposure that are allowed in this investment process. For instance, you can discuss risk budget allocation in tracking error, value at risk, volatility. You can also discuss leverage exposure per different kind of asset classes. You can also add some liquidity metrics in terms of, let's say, size or time to liquidate positions and portfolios. So this framework, as I said, is really important, but should not be fixed in a sense that it has to be definitely backtested regularly, allowing us to be adjusted in order to meet, let's say, the different scenarios analysis that we can run. For instance, stress test, market risk scenario analysis, adding new risk factors in the investment strategy in order to really adjust it to a potential new volatility regime, like what we have observed during the COVID-19. This will definitely give us a framework where portfolio manager will evolve in different market regimes based on different, let's say, tests, on the different tests realized. But reverting back to your question, Stefan, the risk parity is usually the kind of strategy that we usually promote to explain that it can navigate across a different market environment thanks to the strong diversification and particularly on the decorrelated assets. But what we have observed during the COVID-19 that was interesting was the fact that this, let's say, diversification was, let's say, more difficult to find, or let's say less available in the market. Few indicators help us to have such signals. I mean, when you look at the weight of the largest companies in global indices, that has definitely increased in the beginning of 2020, and you can see it definitely in the US global indices with the mega cap stocks that are part of it. And another also angle that we have observed is the way of analyzing the risk contribution when focusing let's say on the number of components that are explaining the risk level. These numbers are felt well in line in the beginning of 2020. So all those factors are leading the path for, let's say, more correlated instrument that could really break the risk parity strategy. But since your strategy already covers those potential situations, but not in the same scale with what we have observed with the COVID-19, then risk manager can start discussing with portfolio manager in order to tackle and to mitigate the risk in the portfolios. So
that's very interesting.
Yeah.
I'm sorry, Saeed. On that point, I just want to bring in Liam, because you make a really interesting point about the flexibility of your risk framework and the dexterity of the framework. And a really hot topic to come out of the first half of the year was how investment firms can, tread that fine line between risk and reward more effectively, and perhaps even more flexibly. In terms of constructing functional risk management practices, and I guess specifically on the topic of collateral management and margining, what did the market learn, Liam? Not just in terms of the volatility, but in terms of the liquidity crunch.
Yeah, I think it's an open question as how much the market has actually learned yet. But I think what the market certainly did experience was a good lesson in how liquidity and operational risk can impact the viability in the market and trading risk. So obviously what happened this year when we got into that really volatile market was you saw a big upswing in margin levels. Initial margin increasing quite significantly, anything up to sort of 100, 150%. Variation margin, obviously a huge margin, P&L swings on the book, so variation margin swinging wildly back and forth through that period. And as a result of that created operational and liquidity stress on a lot of firms in the buy side. So the lesson that was there for people to learn from, and which some firms I think have taken on board, and others maybe will take longer to adjust to, was that if they were unprepared for that swing and that volatility and that liquidity crunch, then it directly impacted their trading profile and their trading book. So we've seen, everybody knows the war stories of firms who are having to literally liquidate positions to get out of the crunch and be able to actually liquidate cash and assets to meet calls. We saw clients who are ranging from banks to traditional asset managers with margin calls doubling overnight and having to rapidly kind of exit positions and redeem funds, etc., to be able to keep up with that. And the kind of lessons and the takeaways that people have got from that, and certainly some firms have learned the lessons well and are putting in place strategies going forward, is that the operational and the kind of collateral liquidity risk is a key part of the risk profile of the portfolio and across the firm. And that therefore those things need to be managed. They need to be managed up front, and they need to be strategized so that you can run forecasting, you can run stress scenarios, and you can run optimization models so that when these things do occur, you are minimizing the impact. So the first thing is to be able to understand that within the front office, what the impact on liquidity particularly is going to be of any trades that are put on, and be able to understand if there are execution routes which are more efficient for that trade to reduce the potential risk. But also having forecasting views, stress scenarios on collateral, as well as on the margin and the portfolios, and the post-trade portfolio reviews were all kind of tools that firms have understood and put into play. And we saw firms during this period rapidly deploying solutions in this space to actually keep their trading risk and the trading profile in place. But by novating, porting trades, optimizing the portfolio, they're able to sort of rapidly get things back under control. And we saw other firms who were caught out by effectively had to come back to the party later and are now deploying more strategic kind of technology solutions. But the key lesson really was that you can only execute your trading strategies if you have the operational and collateral liquidity to do it. And that therefore having transparency and control over that was a key part of the overall trade control process.
Sure. And I think that's a really interesting point that you bring in at the start there. And David, perhaps a question for you, as we look ahead, how will market participants need to prepare themselves if we are indeed moving towards a period of sustained volatility? I think Liam alluded to, some critics perhaps of higher margin levels would refer to some of those unintended consequences, such as the dash for cash, which in some corners have blamed for accelerating losses in certain asset classes, i.e. closing an open position to meet margin obligations elsewhere. To what extent would you agree with that view? And how can we take pragmatic steps to find that balance between risk and reward?
Yeah, those are two interesting questions, and Liam nailed a lot of the key items. But first you mentioned a period of sustained volatility. We've been in one for 6 months now after arguably too low volatility that was pinned down by high frequency trading, maybe some option trades, curtailing market moves. But once those blew out, the market moved very quickly, and a lot of people were unprepared. We've had a few major blowouts from some big firms that you wouldn't expect. But if you're a seasoned professional investor, an asset manager, and as you as a market maker, volatility is our lives. You need to understand it to trade. And it's one component that people just don't understand. But with the onset of volatility and the easy access of trades, lower commissions, you're getting a blurring of institutional, retail, and professional trading all in one. And to the point now that retail is even pushing the market. Our clients cover the gamut of all types of, from asset managers to banks to individuals. And obviously the new entrants don't quite understand volatility. So, they come into the market, they think it's all hunky-dory, I can make a lot of money really quickly. And then they find out one day, what happened to my stock? It's down 20% or it's up 40%. Where'd my money go? Because trading on margin was easy. I have an 18-year-old son. He was asking me for a margin account. Thankfully, we don't provide margin unless you're under 21, unless you're over 21. But I had to explain to him, easy come, easy go. But it's almost a good lesson to learn that someone gets blown out at an early age, learns that it's not that easy. In the last, so how do you deal with it? People are learning you have a lot of volatility in stocks. They're gravitating towards certain names and futures, which are all of a sudden moving, and there's a lot of money to be made. But you just have to understand there's risk there's risk out there. So know your risk tolerance, tighten up your stops. Perhaps if you're more risk tolerant or you're longer term, widen out your stops. Don't get stopped out so easily. And don't fall in love with any position. Just be prepared to move on. As far as margin, that's a tough one. Brokers are on the hook for margin losses. Exchange technically are, but you got to get through the broker's capital before it hits the exchange, and then of course it goes to the provident funds and all that. So traders want low margin because if you're managing margin, it's easy. I don't have to use it. But you have a lot of people taking advantage of it because they can walk away and not pay up. Brokers obviously are, if a client doesn't pay up, they're taking the hit. And exchanges want to charge as low as margin possible because they want to encourage trading. And there are very few instances over the last 30 years where an exchange actually took a hit to the clearing fund. So you have a conflict of interest there. But at the end of the day, for a firm like us, and the firms many of you guys trade with in your firms, what you're trying to do is protect your client. Because if a broker goes down, it's the client funds that are at risk. So we have to find that balance of protecting our clients with high asset values versus allowing certain amount of risk tolerance and margin, because we do make money on margin trading. But we run models and we come up with our own scenarios. We as a firm, we tend to raise margin quickly. We try to anticipate when we see large positions, concentrations, because it tends to be, for example, years ago, I remember that we had some very heavy positions in some of the commodity futures, and it was, it just became a hot topic, and it was excessive risk in market movement. So we had to raise margin. We don't catch it all the time. No one does. But, that's our challenge. For clients, we have something called the Risk Navigator, which you could move your models around and see where you are plus minus 30, 40% and look at your portfolio. People didn't know that existed before, but now all of a sudden you have people asking about it, learning about it. And especially this whole new generation of people trading, they understand at a good time that, hey, there's risk out there. I better learn it. So end of the day, we got to protect our clients and strike that balance between what clients want, what our clients who don't use margin want, what exchanges want, and of course, managing our capital and liquidity. Very tough times, but you live and learn.
That's really interesting. And obviously, speaking of what exchange wants, it leads nicely in a segue to Tony. Tony, David talks about, I guess, the impact of new entrants, but also the hot pot of various exchange participants trading. Currently, what steps do exchanges need to take to promote reliable and resilient markets? And has there been a change in strategy since March?
Well, certainly, Stefan. I mean, speaking to what David just mentioned, he talked about the concentration of particular assets or even the particular type of investors. One of the reasons why at TMX we're trying to expand our reach and extend our trading hours into Asia Pacific. The primary goal of an exchange is to bring as much diversity to the marketplace as possible, both in terms of geography, the types of investors, the users of different traded products. In this way, during times of stress, as we've seen this year, the flows and the investment horizons, the views aren't one-sided. It allows for a more balanced market. And certainly we saw tremendous volumes go through during the first half of this year. I mean, it was multiples of what we saw on daily averages. And certainly the challenge as well has been the fact that, during COVID, we had 95% of our staff working remotely. So it's quite a bit of stress in the marketplace. But the second main reason why, we're looking to expand into Asia Pacific it's primarily because our markets have changed. I mean, the globalization of investments is really driving a lot of what's going on right now. In particular in the pension fund space in the past few years. I mean, recently you've seen announcements from Australia, Korea, Japan. They've all announced, double-digit increases to their foreign investment content. And such a large percentage of Canadian assets now are held overseas and traded overseas. And this is one of the reasons why we've got to start looking at, creating opportunities for our clients and investors, so that we can bring more liquidity to them and give them opportunities to trade other markets on a relative value basis. So as we bring our, index futures, our fixed income futures into Asia trading hours, this allows them to trade the Aussie curve, the US curve, what have you. I mean, I'll give you an example. Just in the months of April and May of this year, the amount of net inflows from Japanese money into Canadian bonds was 6 times what it was compared to the same months in 2019. So those are flows that we have to help to provide liquidity into our markets.
Sure, I think that trend is really exciting, especially for us here in APAC. That trend of exchanges extending their trading hours, not just into Europe, as TMX has itself already, but into Asia, as you will be doing next year. And I guess, David, if I come back to you, if we cast our mind back to some of the big geopolitical events of recent times, the Brexit vote, Donald Trump's election, and then again, forward to November this year, it would be fair to say that some of those significant events have taken part during the Asian time zone when major European and US markets are closed. With investors now increasingly having a global mandate and access to markets in all hours as IB provides, how important and how beneficial is it for traders to be able to access markets around the clock?
I think it's always been the case, and the mantra from our firm, starting as a market maker to as a broker, is the allocation of asset, cash flow, and movement around the world to facilitate risk, or not facilitate risk, but to manage your risk. So it's always been important. What's incredible is the number of people trading at all times, in all hours, and all locations. So if we get in calls, it could be 3 in the morning from the States or vice versa from Asia into the States. The nice benefit of the exchange is adding hours is really, when we get back to the previous question, is about margin. And you can have the exact same product, a perfect hedge, let's say, from the US to Hong Kong, but you're going to get 2 different exchange margins. So, we as a firm, we can maybe lower that risk. Maybe we can charge a little bit less if it's not futures, we can recognize that risk for liquidation purposes. But the reality is we still have to pay separate margins to every exchange. So the client has a big benefit of finding a liquid product on the same exchange and having some, of course, facilitation there. And of course, the more products you have, it's great. The downside is you got to make sure there's liquidity. The more products that get out there trading all hours, you may not have a decent bid-ask spread, or you might have a very only a couple contracts on the bid, and the next tick down could be 2%. So the client fills can be horrendous if the clients don't know what they're doing, and or if a stop gets triggered without thinking about liquidity or depth. So that's the real risk in it. But otherwise, the biggest change I've seen since coming out here so many years ago is that people actually follow Asian markets. Hong Kong doesn't. I used to go back to the States. You couldn't find any news on the Hong Kong market. You might find something on Tokyo, but now everyone looks at Asia. Everyone looks at Hong Kong. Everyone looks at China. It's a great thing, and we see the volume and the results and the opportunity increase because of it.
Yeah, absolutely. Long may that continue. Sorry, Liam.
Yeah, I was just going to add one thing, really, just to support what David was saying there, which is that the same kind of applies to the institutional investors as well. And that one of the key kind of control points you can have to manage this volatility is by actually managing where you're trading and where your kind of margin exposure is, and having the flexibility to be able to have a wider aggregate view and be able to get the benefit of offsetting and portfolio margining through one location, one exchange, one SCM can be very beneficial. It very much depends on each firm's profile. Each firm has different types of solution to get them there, but the type of initiative that TMX is doing actually really does help firms a lot and have the capability to maximize the sort of the margin portfolio effect that they can get.
Absolutely. Taking a slightly different track, Patrice, we've been talking here about liquidity at the market level, at the trading level. But if we do take a step back and look at the investment management level, how do managers protect themselves during such periods of volatility to ensure that the funds themselves remain liquid? You touched on it briefly, but I'm keen to understand, how are you proactively mitigating against investor redemption such that you're putting money to work in the way that you're mandated to, and you're avoiding that nightmarish scenario where one has to put those gates up?
At the asset management firm level, really it starts with what is the nature of the fund and how much liquidity is really expected or desired. So if you take an extreme case, which would be a money market fund, which is really designed to deliver liquidity every day, literally within a day, then it's really in the liquidity ladder, making sure, and this is really something that we have learned in the past and really put to the test in previous crises, sometimes you don't want to have to rely on the market to generate liquidity for your clients. The liquidity needs to come from the portfolio. That's the meaning of a liquidity ladder, making sure that natural maturities within the fund is going to generate liquidity in sufficient quantity to meet the redemptions. But that means also that's on the asset side. That means also on the liability side, which is the shareholders. You don't allow any of those shareholders to dominate. There's not enough concentration to run into issues. And this goes back also to a point that Tony was making earlier, which is make sure also that you have a large diversity of investor profiles, investors who are likely to react in different ways at the same time. So that's at one extreme angle of the spectrum, which is the hyper liquid fund by construction. If you take the other angle, or the other extreme, if you want, which is portfolios of illiquid assets, think infrastructure, loans, private equity, then really this is, first of all, we're dealing there probably with fewer investors and often much more mature investors in terms of the experience. But the point there is really to be really close to the investment itself and really understand what are the stress points, what are the issues that are likely to emerge, and at the same time to be close to the investors to understand their own needs. Ideally, you want to work on the basis of no surprises. You don't want to find out that 20% of your fund is leaving tomorrow without having anticipated it. And usually that's something that we are reasonably successful at, I would say. But this is really in continuation of points I was making earlier about is the design of the fund aligned with all of this.
Sure, thank you for that, Patrice. Said, coming back to you, and apologies for cutting you off a little bit earlier on, but looking at the roles that we all have to take in a period of uncertainty and fulfilling those roles, looking ahead at, I guess, some of the risks out there in the market or operationally, how are you planning to manage that risk against this backdrop of constant operational and infrastructure challenges? I mean, we're talking a lot about remote working, but it doesn't just end there. How's the rest of the year looking for you?
I think that we have already, all panelists are sharing the same point, that it was a very, very long journey during this COVID-19 situation. But depending on each country, the experience of this pandemic has been quite perceived differently. But the common credo was finally for the financial market to ensure that employees' safety was in compliance with the different country public health guidelines, but also being able to cope with the business as usual. We all have participated to business continuity plan, business continuity management training in our career, and on top of that, to have to validate the reactivity of the different department and function with the different scenarios that we have defined. But this pandemic scenario was, of course, part of a BCP, but with the experience that we have gathered during the previous SARS pandemic in the region, but BCP were deemed to function with limited number of employees in a smaller recovery site with a defined number of recovery time objectives. Generally, we are talking about few days. So difference exists really between traditional BCP and how we should adjust it to a real pandemic scenario, notably due to the scale and the duration of this shock. So to rebound on the investment management industry, the primary objective was definitely to ensure the continuation of the essential activities of the fund management, talking about fund manager, traders, if this activity is not outsourced per se, in order to commit to what we have given as an objective and return to our clients and partners, even on a degraded mode. And finally, being able to recover the overall activity in a more progressive mode. The second objective, was to really ensure that the service provided to our client after this, pandemic scenario was at the same level of quality after a very short period of time. And to do so and to navigate into this market uncertainty, we need to have answers on how fast the company can respond to this pandemic and recover from it. So for some countries where, let's say, the pandemic scenario or an equivalent where it was unlikely to happen, the challenge faced with this COVID-19 was the length and the duration, and it has raised a very important challenge in terms of IT infrastructures. Allowing big actors to work remotely when almost all the teams were working at the same time, same moment, in different places across the globe. And this is leading me to the second challenge that financial institutions will face, is that the revision of the outsourced services that definitely constitute a necessary resource for some of the entities. Those service providers are potentially in a critical path for financial institutions to be able to perform in a business as usual basis. I think that for those activities, you all know that it's definitely mandatory to ensure that from a legal perspective, all our contracts include a business contingency plan, usually required by our regulator, but it's secondly to reinforce this plan in including a pandemic preparedness scenario and asking them to provide some KPI on the test that they have raised in order to really ensure that this scenario is taken seriously. So you already read in the news that some financial institutions have decided to move ahead, allowing permanent flexible working mode as disruption of their activity was made really without prejudice. And it was due to really advanced digitalization process, for instance, allowing the full continuity of their activity. So in conclusion, I guess that internally and externally, investment managers will have to adapt, strengthen their infrastructures, their control of the different activities that are outsourced in order to continue to guarantee the good quality and being able to be fully supportive when markets are showing such a real and extreme volatility in the future.
Sure. I mean, there's no doubt that change is, I guess, one of the biggest biggest challenges that all financial institutions face. And looking ahead, Tony, probably one of the most significant changes is going to be one of the biggest changes in the offing for 2021 is going to be the transition away from LIBOR. Obviously, LIBOR hardwired into all manner of financial risk valuation, performance and portfolio modeling. I noticed that TMX has recently launched futures on Canadian overnight repo rates, or CORA, to give it a little bit more of a catchy name. And that's part of Canada's move away from the interbank offered rate to risk-free rates. To what extent is that contract a result of participants' demand, and how do you think the market is shaping up for such significant reform?
Yeah, certainly. I mean, look, in Canada, that transition is has been ongoing since 2018, since the Bank of Canada upended a working group to look at how to transition from the whole IBOR setup. We launched the CORA futures in conjunction with the Bank of Canada's implementation of the CORA index back on June 12th of this year, right? So, I mean, it's very similar to the moves that we've seen in other parts of the world. As you've mentioned, it is the Canadian overnight repo rates average. So, we get away from the embedded credit risk. At the same time, measures have been put in place to look at, it's the general collateral funding in Canada, stripping out. So it's a trim mean average, trimming out some of the specials that you see in the repo market. It's been very well taken up by the market participants. We've seen now in the last 3 months, we've had more than 30 market participants, both globally and domestically, who've now traded the CORA futures. There is a very robust market right now in trading between the CORA future spreads and our BA future spreads, which is the original CDOR-based futures that we have on our exchanges. So, as the transition takes place, into 2021, the market right now is already very well established in that transition. And certainly as the cash market catches up in terms of indexing the bonds to the new CORA index as opposed to CDOR, then certainly the transition on the future side will be seamless.
Sure, and I guess, Liam, this is something that's front and center of your clients' minds.
To some degree, yeah. I would say it's an interesting one again, where there's a little mix of approach. So we deal a lot, as you said, with the kind of broader buy side, the traditional money, as well as the hedge fund space. Some funds, so some of the UK pension funds, for example, have sort of got ahead of this. So in the sort of core rates space, They got ahead, and to some degree, some commentators think they've actually kind of lost out a little bit because they're fixed receivers. They got ahead, they transitioned across in a market which is not really fully liquid yet, so they're effectively paying more than they should to get there. So there's a bit of a mentality of sort of holding back and waiting till a little bit further down the line to really start actually transitioning. And the full analysis of the P&L impact on their books of the transition hasn't really been fully thought through. So as well as the clients we have in the buy side, we obviously work with different banks who are working with the same universe, and this is kind of the same feedback we're hearing around that loop. So although, as you say, LIBOR transition is one of the kind of biggest headlines for 2021, it goes in parallel with the UMR rollout, which is the other big event happening in 2021. So the buy-side firms have sort of these two different sort of challenges or perspectives that they have to accommodate and transition across, and they overlap to some degree. So there's some look at swaps and books that can be novated out of or traded out of bilateral into clear trades, or potentially even the risk replaced in some combination of futures and clear trades, which helps also with the LIBOR transition. But I would say overall, the view of the industry, certainly that we're seeing at the moment, is that it's operationally understood. The risk and P&L impact of it is not fully quantified, and the plan is not really strong yet, not set in stone yet.
Thanks, Liam. And we're running out of time here, so I just want to circle back to you for some closing remarks. I guess one of the topics that we discussed a great deal was this decoupling of asset classes and breakdown in correlations. I think we can all agree that the recovery has been largely driven by risk assets, but haven assets have equally been rallying alongside them. Starting, with you, David, looking ahead, geopolitical events on the horizon, potential for downturn in risk assets. But where is the hedge?
Good question. I think there's some people who jumped the gun and been hedging all year long. But then again, as you said, there's been a massive decorrelation in certain assets. But there's been a flood to gold, movement to gold, the metals. But we've seen an increasing interest from all sides for bonds, because as people move into cash, worrying about a downturn or prolonged downturn, because this recovery is not going to be a V-shaped recovery from all accounts. There's a lot of interest in bonds. What to do with your money when it's zero interest rate environment? So we're seeing good flow into that from all sides.
Sure. And then Patrice, what challenges does that then bring in effective and efficient portfolio construction?
One of the challenges, I think, really is to make sure that there's alignment about the investment horizon of the portfolio and the investment horizon of the investors. Because, going back to your earlier question, I might say, what is it you're trying to hedge? And if it is short-term losses because of lack of capital, for instance, so very clearly, hedges are really hedges, as in, go short futures if you have a long position, or buy out of the money puts, that sort of thing. If you are a long-term investor, in say an equity long-term investor, the risk might be to hedge. The history that we have around, say, the Brexit vote or the election of Mr. Trump is that the knee-jerk reaction of markets around geopolitical events is probably overrated if you're a long-term investor. But not everyone can afford to be a long-term investor.
Sure. Saeed, to what extent do you agree with that?
As mentioned earlier by David and Patrice, not much to add. Just the fact that we are all have fear of a second wave of the COVID-19. We don't know what's going to happen, if we are going to have a limited or no progress on the Brexit talks. We have uncertainty on the China and US relationship, and the uncertainty on the US elections. So all those presents risk for the portfolios. So investors should probably be a bit more prudent and really maintain sufficient edge. And one of the key indicator, and this is what we have all discussed with the different panelists, is the fact that the liquidity needs to be particularly checked and monitored and should be treated alongside of the risk-return combination. And portfolio managers really needs to keep some liquidity buffer in order to not dilute them, and really needs to address the different, let's say, liquidity stress from the assets and also from the liability side to really be able to adjust their portfolio positioning on a more regular basis. And what you have noticed is also that regulation is more and more looking at this. We have the ESMA regulators currently working on the liability stress test scenarios for in Europe side, and recently MAS in Singapore and the SFC in Hong Kong are more and more looking at the redemption, let's say the feature of the different funds that we manage in the region.
Thank you very much for that, Saeed. And Liam and Tony, I just invite you to share any final thoughts that you may have.
Sure. I think certainly the governments are benefiting from this, push towards bonds as they have to fund their COVID responses. But my concern is the swings, right? Your big swings into safe haven trades at the moment. What happens, as those get unwound in future months and so on. So, we continue to see the volatility, and that's not going to go away.
Yeah, and I would only add to that, I think, to support any type of investment mandate or strategy, one of the key points that everyone is talked about here today and has been evident this year is to have a complete control system around your trading portfolio and all of those sort of post-trade impacts. And that then comes back into understanding all of the kind of the collateral and the collateral liquidity elements to that. So as long as that's part of the front and the middle office process, you're at least then positioned to allow the portfolio managers to make the right decisions that they need to make.
Fantastic. Liam, thank you so much. And thank you, gentlemen, for giving up your time today and sharing your experiences of really what has been a unique time, and obviously looking ahead, plenty of volatility, I'm sure, on the horizon, plenty of challenges to navigate. So thank you very much for giving up your time today and sharing your views with us. With that, I'm going to pass back over to Oliver. Thanks again.
We've been very lucky to have a few of the speakers are able to join us today. So if you do have any questions, you can just click on that button and send them through, and we can start getting you some answers. We've already had some come through. So I saw for the first one, what is the most critical risk to be managed in the current environment? I'll leave it open to who wants to answer that.
So most critical issue for risk management in the current environment, I mean, there's a list of issues, but I would say if I had to pick only one, I would say liquidity management with respect to the flows that our clients have into their investment portfolios in and out, of course. But interestingly, also when it comes to mutual funds or unit trusts or any type of commingled investment, an important issue has proved to be also protecting the fund holders that stay in those schemes with respect to the others who are moving in and out and generating transaction fees and transaction costs, and we had to move quite swiftly on this. If I had been asked the same question a few months ago, I would have said worry number one is operational risk, with 95% of the teams working from home and new equipment, etc., etc. And of course, operational risk is always a concern, but the spike in operational issues that we were, the possible spike in operational issues that we were worried about as we were entering this period, fortunately, did not materialize. So that would not be the number one.
Yeah, further to Patrice's point, I would certainly advocate liquidity management at the trading level is incredibly important. You've got to be confident in knowing the value of your position, be confident in your marks, and probably most importantly, knowing where your out trade is, especially if you're trading in more illiquid products or more illiquid parts of the curve. Optiver is a very active participant in listed markets, but even there, as you go down further longer dated tenors and you start trading down the curve, or in specific markets, liquidity can be a question. So knowing your position and knowing where the out trade is, should it go against you, I think is probably one of the most important takeaways from the last few months.
And then the follow-up question is, how has your advice to clients changed as a result of the extreme trading conditions that arose during the COVID-19 pandemic?
Okay, so I'll take a stab at this. David Friedland from Interactive Brokers. We don't give advice on any particular stocks or securities, but you need to be aware of systemic risk given the massive increase in volumes, extreme market moves that can materialize out of nowhere. You have some insane moves in stocks. I mean, look at some bankrupt stocks that went up several 100%. Just because of the herd mentality, or even in Hong Kong, you had Next Media that had crazy moves on news, but not fundamental news. So you just have to be nimble, be aware, and expect the unexpected, and keep a cash buffer.
If I may add, I think that is really important to express to your client that in that particular situation, they need to keep some liquidity buffer on their side in the portfolios to really go through this very uncertain, environment in the market. So liquidity is definitely key.
If I can follow up on this, and this is Patrice here from HSBC Global Asset Management, and completely agree with everything that David and Said have covered. Maybe at a more tactical level, dealing with particularly our institutional clients, the reality is that we tend to be long-term investors, but when you have so much volatility, views tend to change more often, and that was definitely a change for us because prices and even fundamentals change more quickly. Strategically and looking perhaps ahead, for us the big changes, perhaps the biggest change this year has been to advise to our clients to start to look at diversification in different terms, and particularly over the last several years, government bonds, treasuries have played a wonderful role as a diversifier, as a risk dampener, you might even say, with yields having sunk to the levels that everybody on this call will be familiar with. It's doubtful that they can play the same risk to the same extent or with the same success in the future. So that would be one big change from our perspective. On the flip side, one thing that doesn't change, and I think is always good advice when looking at multi-asset portfolios, diversified portfolio, is when you have so much volatility, don't forget to rebalance. Thank you.
Tony, any comments on the topic in general, or things that we should be looking out for in the future?
Well, I can only echo what my esteemed colleagues have all mentioned. I mean, clearly from an exchange perspective, it's operational risk. It's making sure that your IT infrastructure is certainly in place, and you have the capacity to deal with the extreme volatility and the extreme volumes that are going through. And, again, liquidity is absolutely, an imperative in the sense that not only at the client level, the portfolio level, but also certainly, with the clearing houses and the exchange level and at the national level. So, I mean, what the governments have done around the world in stepping in and providing the right liquidity at the right time has been extremely helpful in what we've seen in the last 6 months.
Oh, and that links nicely because you just mentioned you have to have the technology in place. So I'll just pass that on to Liam. Any further comments?
Yeah, thanks. I would actually just sort of echo that point and follow that point, which is as well as actually obviously managing the trading risk and volatility. It's certainly for institutional firms and longer term asset managers, it's vitally important to ensure that you are correctly managing your collateral and funding liquidity as well. So liquidity in all dimensions of your activities, but collateral and funding and forecasting are critical to ensure that you're not being forced out of positions in a volatile market that goes, in inopportune ways. And we've found lots of firms that certainly had some stressful experiences with that during the peak of the volatility.
Can you elaborate more on margin requirement and calculations?
Can I elaborate more on margin requirement? Okay, I can spend all day talking about margin requirement calculations. I think in the context of this, I'm not entirely sure what the focus of the question is there, but I guess in the context of this discussion, the issue really is that the margin requirements, both on initial margin requirements, were obviously reflect and react to volatility and activity in the market. So they were increasing rapidly, and in some cases doubled, or more than doubled, in fact, very, very rapidly. And at the same time, you also had very large variation margin movements as markets were moving rapidly all over the shop. So the combination of margin requirements, and this was reflected in all areas of activity. So listed futures, options trades, ETD exchanges, but also in the kind of cleared world. And luckily, at this point in time, most of the buy-side firms weren't under scope for the UMR regulations as well, but that would have come into play at the same time. So the margin requirements themselves are obviously different calculations and models depending on which clearinghouse or type of contract you're trading. But in general, they reacted to volatility and were rapidly increased on top of very large variation margin calls that were happening.
I think that's all we have time for actually for this session. I'd like to thank everyone.